Hello and welcome to this session on Chapter 5 Risk and Return. Thinking about returns. Investors evaluate the attractiveness of potential investments based on the anticipated trade off between risk and expected returns. After covering this chapter, you should be able to calculate ex post and ex ante risk and return statistical measures such as holding period returns, average returns, expected returns, and standard deviations. Specifically, in this chapter, we will be discussing the historical record, inflation and real rates of return, asset allocation across risky and risk-free portfolios, and finally, we end the chapter by understanding the passive strategies and the capital market line. Let's discuss now rates of return. So as I said, the rates of return is based on the data you have. If you have the historical data, we use what we call it as ex post. And if you have the futuristic data or forecasting data, then we call it as ex ante. Okay, so in both the situations, ex post means historical or past data, and in ex ante we use what we call it as future data or forecasting data. Another important thing which we'll be discussing in rates of return is we'll be talking about whether we have single period or multi-period. Another important aspect which we'll be seeing on the rates of return is whether we are going to talk about dollar weighted or time weighted. Okay, so usually in the rates of return we'll be discussing in this three context. If we have historical data, how you are going to compute the single or multi-period return, or the dollar weighted and the time weighted return. Okay, so let's start the single period return. The single period return or one period investment, regardless of the length of the period, we can use the holding period return. The holding period return is very simple. It uses the ending price minus the price at which you buy the stock plus any cash flow in between which you receive and divide by the price of the stock which you buy. So why use percentage of returns at all? Yes, why use percentage returns at all? Ponder, think. Percentage of returns removes size of investment concerns. Then the next question is, what are we assuming about the cash flows in the holding period return calculation? The cash flow should occur at the end of the period, otherwise missing reinvestment of those cash flows. Or we may be thinking the cash flow could be the future value of any interim cash flows. Let's understand the HPR using a simple example given in the page 110. Suppose you buy one share of stock today for $45 and you hold it for 2 years and sell it for $52. You have received $8 in dividends at the end of the 2 periods. So your beginning price is $45, ending price is $52, and the cash flow generated through dividends is $8 at the end of the 2 years. So using this data, we can simply compute like this: 52 minus 45 plus 8 divided by 45. So holding period return can be segregated as capital gain yield plus dividend yield. So the capital gain yield is given by how much gain you got. So the current price, or the price at which you sell the stock, 52 minus the price at which you bought the stock, divided by the stock price which you buy. So this will give me the capital gain yield. And the dividend yield is simply how much is the dividend you received, $8, okay, divided by 45. So the answers which you get from this should be the same. If you take the calculator, compute this. So you have 52 minus 45 yes, how much you got? So you should get 0.1556, 0.1556, and with this you should get 0.178 if you take to 3 digits. So if you add this 2, that becomes 0.156 plus 0.178 should give me 16 point should give me 33.33%. So that is 0.3333, okay, or 33.33%. So remember that this is what you received, and this you are doing without compounding. So this is annualized without compounding. So if we go for annualizing without compounding, it is the HPR divided by 2. Why? Because we have n is 2. N is 2. So this you are going to do in the case of you have greater than 1 year. Now talk about the annualized HPR, assuming annual compounding is n is equal to 2. So if we do the annualized HPR using this, so you have 1 plus HPR to the power of 1 by 2 minus 1, that will give me 15.47. Okay, so let's go into understanding this annualizing HPRs. Why would you want to annualize returns? Remember that annualizing HPRs for holding periods of greater than 1 year, we use without compounding this formula. In the previous problem with compounding, we use this formula. So this formula is what we call it as APR and EAR. What is APR and EAR? APR means annual percentage returns. Okay, annual percentage rates. APR is annual percentage rates. And what is EAR? EAR means effective annual rate. Effective annual rate. So why we use this? Because it ignores compounding. The APR does not equal the rate at which your invested funds actually grow. So this is called the effective annual rate, or EAR. When there are n compounding periods in the year, we first recover the rate per period as APR by n or HPR by n. Okay, holding period return or annual percentage rate divided by n. So when we use this formula, when the compounding, when there are n compounding periods in the year, okay, and then compound the rate for the number of periods in a year. For example, n is equal to 12 for monthly payment mortgages, n is equal to 2 for bonds making payments semi-annually. Okay, so the same formula is again applied here. If you can see it, annualized without compounding and this. Okay, so what we have done APR by 2, that is annualized without compounding. Here we are using EAR. What is EAR? Effective annualized rate. Okay, so this is the formula. So what is the formula we have? 1 plus APR or HPR to the power of 1 by n minus 1. So this will give me the HPR or APR annualized rate, okay, with compounding. Okay, now let's go to the next. Annualized HPRs for holding periods of less than 1 year. So the previous case we have done for more than 1 year because we have invested and waited until 2 years. Okay, the previous problem. In this problem we are talking about if you have less than 1 year investment. Suppose you invested in the stock and you find the stock is making, like say the case of if you have invested in Saudi Aramco IPO, you got it invested at $32 or Saudi Arabian Riyal, and this it gained. When it was listed, it was going up and up, right? And if you want to sell it off and make a return quickly on this, so you are not holding for a complete year, you are holding less than 1 year, or at the moment the Saudi Aramco is falling down. So what you are going to do in this situation? Are you going to keep hold of this, or you want to minimize your loss by selling it? So it all depends on how you are taking care. So if your holding periods is less than 1 year, how you are going to compute. So the simple HPR is HPR times n. In the previous case, if it was more than 1 year, what we have done, we have divided by n. In this case, what we are doing, multiplying by n. Here also the compounding period is changed. We are not dividing 1 by n, we are just raising to the power of n. Okay, so this is the difference between, if you are holding for less than 1 year, you use without compounding the simple formula of HPR, and with compounding, that is annualized, we use this formula. So let's take one problem. Suppose you have a 5% HPR on a 3-month investment. Okay, what is the annual rate of return with and without compounding? So without, n is equal to 12 over 3 is equal to 4. Why? Because in a year you have 12 months, so you are holding for 3 months, so 12 by 3, n is 4. So HPR is, you have already 5%, so 5% times 4 will give you 20%. So with annualized compounding, it is simply 1.05 to the power of 4 minus 1 will give you this. Why is the compound return greater than the simple return? Yes, think. Okay, did you get it? Why is the compound return greater than the simple return? The reason is, in the simple return, we are not reinvesting whatever you are receiving in between. Okay, so you invest only on the buy price and wait. So that means you are not including the investment pertaining to or reinvesting the interim payments which you receive. In the case of why this is more, because here we are reinvesting the interim payments also, so this it takes into consideration. That's why it is more realistic. Okay, now coming to arithmetic average. Suppose we have multiple time periods instead of a single time period, right? The single time period could be less than 1 year or more than 1 year. That means you are holding for 2 points of time. Okay, you invest and then you reap here in this point of time. This could be 1 year, it could be 2 year, or it could be 3 year, whatever, or it could be 3 months or 2 months or 1 month. So that means you have 2 points in time. But suppose you have invested today and you have different points of time, right? So that means you are getting returns in different points of time. So if you have this kind of situation, how you are going to deal in the calculation of return or computation of return? So finding the average HPR for a time series return is simply taking the arithmetic average of the returns of all these periods. So in a multi-period, what you do is you assume each period as a single period, compute the HPR for each of these individual periods, add all this and divide by the total number of time periods. So that becomes my simple arithmetic average using the holding period return. So you are going to compute return for this period, then for this period, for this period, for this period, for this period, and for this period. Okay, so once you have HPR for this period, this period, this period, this, you add all this and divide by how many periods we have. 1 2 3 4 5 6 6 divide by 6, you get the arithmetic average. So this is how you are going to deal for a time series of returns. But there are two considerations, as we said in the beginning. It could be arithmetic average or it could be geometric average. So if you have a this is the example how we do this. Okay, so we add all this HPR returns and then divide by the number of years, so you get this arithmetic average. So another important, as I was mentioning, was the geometric average. So the simple arithmetic average is without compounding, and if you want to go for compounding, that means reinvesting your returns each year. That means you are not taking away the returns which you receive at the end of the time period. You are reinvesting them. So if you reinvest, what is going to happen is you are going to use the multiplication power. Okay, that is what we call it as the compounding power. So instead of the summation, in that case we have multiplication, that is the pi. Okay, so we use pi means multiplication. Okay, and this means adding, summation. So arithmetic average summates it or adds the number of observations or the calculated HPRs. In this case you are going to multiply, it's a product. Okay, so how you are going to do this? 1 plus HPR, right, and raised to the power of 1 by n minus 1. So multiply all this, right, not add. This is a usual mistake made by students. In geometric you are going to use multiplication, that is the product of each of the HPRs, and raise it to the 1 over n. N is the number of time periods you have, and then when you minus 1 you get the HPR geometric average. I think this is clear. So finding the average HPR for a portfolio of assets for a given time period. Suppose we talk about uh, investing in different assets. In the previous cases, we were talking about investing in only one asset. Suppose you have number of securities in your portfolio. What is a portfolio? Portfolio is a group of assets. In the previous versions, we were discussing about how to compute the value of a single investment in single period or multi-period, right? For a single period, we have shown how to do using HPR and with a compounding, that is effective annual rate and annual percentage rate. We have done that, right? Then we discussed another important aspect was if we are talking about uh, different time periods for a single investment, how we are going to do that is through either arithmetic average or a geometric average. Now you are investing in more than one asset, that means 2 asset, 3 asset or n asset. So if you are increasing number of securities, that means you are going to invest in Aramco plus say Almarai, or maybe Aramco, Almarai and Safi, okay, or Pepsi Cola or whatever. Okay, so any business you want to invest. Uh, so the formula we use is the portfolio formula. So for a 2 asset, the formula is given as a plus b whole square form, that is a square plus b square plus 2ab. Okay, so this is what we call it as portfolio return. So let's understand using this example. Suppose you have $1,000 invested in a stock portfolio in September. You have $200 invested in stock A, $300 in stock B, and $500 in stock C. The HPR for the month of September for stock A is 2%, stock B is 4%, and stock C is minus 5%. So that means the total investment you are going to make is $1,000 splitted into individual stocks. So I am having $1,000 to invest in my portfolio, and I am investing 200 in stock A, 300 in stock B, and 500 in stock C. So it will be weight of stock A times HPR of stock A plus weight of stock B times HPR of stock B plus weight of stock C times HPR of stock C. So that gives me something like this. Okay, so how to get the weight? Weight is nothing but, so weight of A is given as how much I'm investing in A, 200. Okay, 200 divided by 1000 is my total investment. So this gives me a weight of HPR A, right? So 0.2 times, how much is the return I get? 2%. So 0.2 times 2%. Okay, so this is how it gives me. So you have zero point 0.2, zero point 0.3 the weight of B, okay, and the weight of C is 0.5. So if you multiply these with the returns, you get a negative return of 0.9%. I think this is clear to you. Measuring returns when there are investment changes or other cash flows within the period. In the previous examples, we were assuming that uh, the returns were coming at different points of time without consideration of the dividends. But suppose you are also receiving dividends, so you need to account on this. So for example, today you buy one share of stock, $50. The stock pays $2 dividend 1 year from now. Also 1 year from now you purchase a second share of stock. 2 years from now you collect $2 per share dividend and sell both shares for $54 a share. What was your average annual return? It depends. There are different ways to measure this. Okay, so we use the dollar weighted return and time weighted return. So what is dollar weighted return? Dollar weighted return procedure finds the internal rate of return for the cash flows, that is, find the discount rate that makes the NPV of the net cash flows equal to 0. So it's something like your IRR. Okay, so internal rate of return. Tips on calculating dollar weighted returns. This measure of return considers both changes in investment and security. Initial investment is an outflow, ending value is considered as an inflow, additional investment is an outflow, security sales are an inflow. So if you take this example, dollar weighted return procedure, find the internal rate of return for the cash flows. Okay, uh, find, that means you are going to find the discount rate which is going to equalize the cash flows to 0. Okay, so that is what is nothing but NPV of net cash flows equal to 0. So if we do this and solve for IRR in this, you get 7.17 average annual dollar weighted return. So please remember that the dollar weighted return gives you an average return based on the stock performance and the dollar amount invested. That means the number of shares you bought and sold each period. Okay, so it's a very good measure, dollar weighted. You are paying somebody to advise you which assets to buy, but you are deciding when to buy and sell shares. If you want to evaluate the quality of the investment advice you are getting, should you use dollar weighted returns to evaluate the quality of the investment advice? Now let's look into time weighted returns. Time weighted returns assume you buy one share of the stock at the beginning of each interim period and sell one share at the end of each interim period. The time weighted returns are thus independent of the amount invested in a given period. To calculate this, we use calculate the return for each time period, then calculate either an arithmetic or a geometric average returns of the returns. Okay. Time weighted return, let's see one example. Initially buy one share at $50 in 1 year, collect $2, okay, and you buy another share in 2 years, you sell the stock for this after collecting another $2 dividend per share. So if you use this situation, you can get the time weighted return, okay, something like this. So time weighted return assumes you buy one share of the stock at the beginning of each period and then sell it at the end of each period after collecting any cash flow. So it is something like this. So at year 0 you invest $50, right? At the end of year 1 you receive $2 in dividends, plus you are selling it at $53. So that means you are making a profit or capital gain of $3. So 3 plus 2 is what is your return you achieve in year at the end of year 1, and then immediately you invest this $53, right? And when you invest this in $53, at the end of year 2 you receive another $2 as dividends, and then you have at the end of year $54, you sell the price of the share. So this is how you can use the time weighted returns. So this is independent. Okay. Okay, so that means you calculate the return for each time period, and then you can use the arithmetic and the geometric average returns. Okay, measuring ex post past returns. Same example as before. Initially buy one share at $50 in 1 year, collect $2 dividend, and you buy another share $53 in 2 years. You sell the stock for this after collecting another. So you have uh, time weighted return, something like this. Okay, is it clear? So HPR for year 1 is 10%. How? Because we buy for $50, okay, and we receive dividends, right? So 53 minus 50 divided by 50 plus 2 by 50 is going to give me total HPR of $10, 10%. Then again I invest 53, right, and sell at 54, so the same will give me 5.6%. Then you can use these two periods to calculate the arithmetic average or geometric average. So to calculate the arithmetic average, we simply take the HPRs for the two different years, and since we have two time periods, so we divide by 2 to get 7.83 as my return for this 2 years time period. Okay, or you can use the geometric average returns also, using the product of this to the power of 1 by 2 minus 1 will give me HPR 7.81. okay, so what do you observe here? 7.83, and here you have 7.81. Why it is like this? So the question is, when should you use the geometric average return and when should you use the arithmetic average return. So when you are evaluating past results, that is ex post, use the average arithmetic return without compounding. If you are not reinvesting any cash flows received before the end of the period, but if you are reinvesting any cash flows received before the end of period, then you are going to use the geometric average return. So in this case, in the previous case, what we have done, we have reinvested this, right? But we are taking away $2 the dividends. So since $2 is not invested, so my geometric average return is not accurate. So therefore it's showing lower side. So that's why in this situation, since the $2 which I am receiving at the end of year 1 is not being reinvested, so therefore I am going to use arithmetic average return. I think this is clear. Okay, so use the arithmetic average return because we have not reinvested. So when you are trying to estimate an expected return, now till now we were discussing ex post, that is using the past data, right? Using the historical data, and then we were working on calculating the return. But suppose when you are trying to estimate an expected return, because you invest today and you are expecting in future what you are going to receive. So since this is a forecast, and this forecast you are going to use arithmetic average return. Okay, the geometric average return will not give you, but it requires to take into account what we call it as scenarios. Okay, so you need to build scenarios. So if you are expecting in the previous case the HPR was 10%, this you received it, but suppose we are talking about HPR 3, HPR 4, that means these are in future, and we are standing in year 2 at the end of year 2. So the current year is at the end of year 2. So you are going to project what is going to be the returns in future, uh, 1 year from now and 2 year from now. So this future is uncertain. So therefore you need to take into account or build scenarios. So let's discuss those things in the next section.